So gold is a pariah, and we know from history that it has times when it comes back into the limelight, and I think the stars are aligning for that to happen.
If you take a look at gold's historical bull runs over many years, 2011 was one example. You said it went from $300. Before then, after Nixon took us off the gold standard in 1971, gold rose from a couple $100, 100, I think less than $100.
Less than $40.
Less than $40, yeah. All the way up to, I think, $800 was
the number everyone uses, right?
1981 peak. It just seems to me that it goes multiple times in every single bull rally. Yet in the last bull cycle that we saw that peaked in 2020, it didn't go up that magnitude. Do you think that if you were to assume that gold follows historical precedents, maybe we haven't seen the real bull rally yet?
Oh, I think we've just, this is the first act. And where we are now is, I think we got up to 2,200 during COVID, and we've come off that. I just think that we are just building compression for the next move higher.
Why is it that gold went from a couple $100 to almost $2,000 in 2011 between that 10-year period? I mean, there wasn't a big inflationary period. It wasn't hyperinflation. Mm-hmm. To my knowledge, the dollar didn't collapse during that period. What was the catalyst there?
And I like to use 2000 as kind of a starting point.
Yeah.
And the reason for that is that was kind of the beginning of radical monetary policy. You had Greenspan driving interest rates to really low levels. You then had the housing crisis, and then the Fed response, which was to inflate the balance sheet. So you're right, we didn't have inflation. And I think it's important to make the point that inflation is not necessarily the rationale to own gold. Gold really is an asset. Everybody knows this, that doesn't have any counterparties. It's what you want to own during a financial crisis, which we had in 2007 and 8. We came near to that in COVID. And I think the next time around, that argument will bear itself out. Inflation, too many people just say, is the only rationale for gold. It can be a rationale, but it isn't necessarily a rationale.
Let's say this year and say, well, CPI's gone up and actually gold's gone down last year and then stay flat this year.
Totally
so
right.
Clearly you didn't track inflation. How would you respond to that?
Yeah, I would say, I think that a lot of investors have been very disappointed because we have had inflation. Some of us predicted inflation well before the Fed figured it out. And once inflation began to be front page news, gold basically petered out. I don't think you can look at short periods like that. If you look at long spans of time, I would say that gold has kept up with inflation, but I don't think that's the reason to own it. I think it really is the real safe haven. We know that balanced portfolios, 60-40, have been a disaster this year, mainly because the 10-year and all the other instruments you can think of, fixed income, have performed terribly. Year to date, I think gold it's down, but it's not down anything like that. I think it might be down 5-6%. If you go back to the 1970s, you basically had double-digit inflation, and you had the need to come in and squeeze every bit out of inflation by going to high interest rates, which slowed down the economy for a long period of time. And we are now at a time that is more precarious than any other time since 1970. And the reason for that is the level of debt that's in the system. Global debt to GDP ratio is higher than ever. And that means that the usual antidote for inflation, which is raising interest rates, slowing monetary growth, the repercussions of that going wrong are higher than any time in history.
Is there a relationship between the level of debt relative to GDP and economic growth of that country? In other words, GDP versus debt?
Sure, the higher the debt, the lower economic growth. But debt, ultimately, if it's going to be repaid, slows economic activity. If you're going to service the debt, it basically retards economic activity.
You could just not pay back the debt, default.
Which gets into systemic risk argument.
Is there a possibility of a default in the US? I mean, there have been historical precedents of many defaults, let's say in the late 70s, and then in the Civil War, there was a short period of default. Mm-hmm. But the US is rated AAA, and by most
rating agencies, which of course are,
If we were to enter a period in which a sovereign debt crisis becomes not just fiction, but more or less reality, that would be unprecedented for the US, would it not?
So before that happens, we're going to have a ton of defaults in the subprime sector. We have to roll over something like $1 trillion of debt, corporate grade and high grade, and particularly low grade debt in the next 12 months. Most of that stuff, a lot of it has been financed on the short end of the curve. So what we're seeing now is the policy rate is now 4%. These guys are used to paying 2% or 1%, light covenants, all that. I think we're going to see a lot of defaults in the next 12 months. That could blossom into a sovereign debt default, not so much in the sense that, well, you're not going to get paid back, but you can default just by printing more money. And I think that's where we're headed.
Why would these companies, let's start with the corporate sector first, why would there be defaults? Is it because we're entering in a recession?
We are entering a recession. First of all, let's get back to inflation.
Yeah.
The market was down a lot, big time yesterday.
Correct.
Because it was a bad print on CPI and the core CPI. What I think the market has to come to grips with is that there's not a quick fix here, and that if Powell and company is going to get back to 2%, it's going to take quite a while, and it's just not going to go. So if they're going to apply this kind of medicine, which is what he's going to do. I mean, Powell is on record when he was on the FOMC as being opposed to all this balance sheet expansion, but he voted in favor of it. I guess that's his political side. But I think he's a man on a mission. I fear, and I think we just saw Jeff Gundlach say this yesterday, that he could go too far. And so I think where we are with the Fed is that they don't have a dial to sort of modulate economic activity like everybody would like to believe. They basically have an on switch or an off switch. And the off switch is to crater the economy.
One could argue that in order to combat inflation, he needs to be almost Volcker-esque in the sense that he needs to raise rates to be equal to the rate of inflation, which is nowhere where we are currently.
So let's say that what are they going to do this next meeting? Raise it 100 basis points. That'll get us to what? 3.5%. Inflation running at 8%. Let's say it's going to moderate. It may well moderate with slowing economic activity. But to get, let's say it's even 6%, you need to get to 8% on the policy rate to crush it. And today the economy is more fragile than it was. The debt to GDP in the 1970s and early 80s was a fraction. It's like 30 or 40%. Today we're at 120% or 130%.
Powell's condition is not like Volcker's condition. He does not have the leeway to raise rates that far because then the Treasury would not be able to afford interest payments on the current and future.
Yeah, one thing I didn't mention is that every 1% rise in the interest rate paid on that 30 trillion of debt adds 300 billion to the budget deficit, which is already so there are real constraints that can only be if Powell is going to follow through with what he claims he's doing to get back to 2%. I think we'll be in recession for a couple of years.
Maybe they can restructure the terms of the debt, or perhaps structure it in such a way that only new debt gets the higher interest rate.
Well, one thing we know for sure is when things go poorly, governments change the rules. And that would be another way to tick the box under the category of systemic risk.
Why you think long-term the dollar would depreciate, or in your own words, face some sort of calamity. Well, you didn't use the word calamity, but you said that it would face some problems. The DXY, for example, over the last year and a half has been just steadily increasing. And of course, relative to other currencies like the euro, it's at a 20-year high.
Right.
So it doesn't show signs of slowing momentum right now.
Well, that may be true. When I hear the strong dollar argument, I always ask the question is, if gold was at 300 in 2000 and it's now 1700, what does that say about the strong dollar? I mean, gold has gone up during periods of weak dollar and strong dollar. So it's quoted in dollars. So again, I find this to be, first of all, we live in a day and age of machine trading, and you have these algorithmic traders who position long dollar, short gold. There's no gold being traded. It's all balance sheet to balance sheet. If you look at premiums in Asia, I think in Shanghai they're running at $25 above spot, and in India I think it's $70. So that's the real market.